Welcome back to the Deep Dive. Our mission is to take those dense, jargon-filled earnings calls and just, pull out the nuggets of knowledge you actually need.
And today we are sinking our teeth into Applied Materials, ticker AMAT. Specifically, their Q4 fiscal 25 results, and maybe more importantly, what they said about the future.
Yeah, and this one is a must-dive because we're looking at a huge contradiction. On paper, AMAT just wrapped up a record year. Just incredible growth.
But the market reaction was not great. A sharp sell-off, the stock stumbled, and it seems like all that good news was just overshadowed by some near-term headwinds and maybe a flat outlook.
That's the conflict we need to solve for you. How does a company hit a revenue record, talk about dominating the next wave of AI tech, and still manage to disappoint Wall Street?
It's all about those fault lines between the long-term story and the short-term reality.
Okay, so let's start with the numbers. We'll keep it quick. Q4 FY25.
Right. Non-GAAP diluted earnings per share came in at $2.17.
And that beat estimates. Not by a lot, but a beat is a beat.
Yeah.
Net revenue was $6.8 billion, also a modest beat.
But here's the number that I think spooked the street. That $2.17 EPS, despite beating estimates, was actually down 6% compared to the same quarter last year.
There it is. The growth curve was slowing down right as they entered the new year.
Exactly. So that sets this really cautionary tone, even when you look at the full year, which was, genuinely stellar.
6th straight year of revenue and earnings growth.
Yep. Record revenue of $28.37 billion, up 4%. And non-GAAP EPS hit $9.42. That's up a solid 9%. The underlying strength is there.
And you can see that strength in their margins, right?
Yep.
Non-GAAP gross margin hit about 48.1%.
Which is a 60 basis point improvement. For a company this size, a jump of 0.6 percentage points is just massive execution.
They're saying it's a richer product mix, so selling more of the high-end stuff, and just good old cost discipline.
But let's add a little friction here, because the GAAP operating margin actually went down. It fell pretty hard, 380 basis points.
And why was that?
R&D and just general operating expenses grew faster than sales. So they're investing heavily. You can see the tension.
Spend money to make money.
Yeah.
Which might explain the roughly 4% workforce reduction they announced.
Management framed that very carefully, not as a weakness, but as retooling their costs now to get ready for that big AI growth leg they see coming.
Okay, let's look at the business units. I really want to focus on Applied Global Services, or AGS.
AGS is the cyclical shock absorber. It pulled in $6.4 billion in revenue. But here's the key takeaway.
What's that?
Management said that more than 2/3 of that core AGS revenue comes from subscription-like agreements.
And that matters because in a boom-bust industry like semi-equipment, that recurring revenue is gold. It puts a financial floor into the whole company, right?
Right. It completely de-risks the model. And they're backing that up by returning a ton of cash to shareholders, about $6.3 billion in buybacks and dividends.
Wait, that's more than 100% of their free cash flow for the year.
It is.
So if R&D costs are rising and they're gearing up for this huge AI investment cycle, is returning all of that cash really the right move? Aren't they kind of starving the beast?
That is the big capital allocation question. Management clearly thinks they can do both. They're investing where they need to, while sticking to their goal of returning 80 to 100% of free cash flow over the long run.
All right, let's pivot to where they're actually spending that R&D money. AI. This is the whole long-term thesis. CEO Gary Dickerson said AI has hit a tipping point.
And that's not just talk. They're citing third-party forecasts that see the whole semi-industry growing 10 to 15% annually for the next 5 years, all fueled by AI. It's a huge wave.
And to catch that wave, you need the right surfboards. AMAT is highlighting 3 specific products here. First, the Centura Xtera Epi system.
This one is, it's essential. It's what enables gate-all-around, or GAA, transistor structures for 2-nanometer chips and beyond.
In simple terms.
It lets chips get way faster and more power efficient. You absolutely need it for the kind of computing AI requires.
Got it. Second, the Kinex integrated system.
This is the first system that can do die-to-wafer hybrid bonding. Think of it as stacking chips vertically, like tiny skyscrapers.
Because you're running out of room to build them horizontally.
Exactly. This tech basically locks AMAT into the manufacturing roadmap for the most complex AI chips for years.
And the third one is the Provision 10 E-beam metrology system.
Metrology is just a fancy word for measurement and inspection. This tool boosts image resolution by 50%, which you need to find tiny defects in these new 3D devices.
And all of this is going to be anchored at their new EPIC Center in Silicon Valley, opening in 2026.
Right. It's an expensive bet, but it ties them directly to their biggest customers for developing the next generation of everything.
So that's the multi-year bull case. Now let's get back to the reason for the market's skepticism. The near term, and of course China.
This is the core headache. Export controls are hitting them hard. Revenue from China, which used to be near 40% of their total, is now down to around 25% in Q4.
And they're guiding for China spending on equipment to be even lower in 2026.
Yep. The new U.S. controls alone are expected to slice off about $600 million in revenue in fiscal 26. That is a substantial hole to fill.
But there was a little bright spot, right? Something about an affiliates rule.
Yeah, a temporary suspension of that rule. It let them ship about $110 million worth of delayed tools in the first quarter of 26.
And the really critical part.
If that suspension becomes permanent, it could restore up to $600 million in annual sales. It could completely neutralize that regulatory loss. So it's a massive swing factor.
Okay, so what are they doing about it? Just taking the hit?
No, they're reallocating that lost production capacity, moving it to serve the new fabs being built in Europe and the US, where demand for the advanced stuff is ramping. They're trying to diversify away from the political risk.
Which brings us to guidance, the thing that really moves the stock. For Q1 26, they signaled a plateau.
A plateau is a good word for it. Revenue around $6.85 billion, EPS of $2.18. It basically confirmed that growth is, flattish for now.
But the key message for the full year was all about the timing.
Exactly. Management expects the first half of the year to be flat, followed by and I'm quoting here, material acceleration in the second half of 2026.
Fueled by AI chips, high bandwidth memory, all the stuff we just talked about.
And their confidence in that second half ramp seems unusually high. They said customers are giving them more than a year, sometimes 2 years of visibility into their factory plans.
So they're not guessing about the second half. They say they're confirming already booked capacity.
Which is why that sell the news reaction feels so weird. The market focused on the next 6 months of flat and kind of ignored the certainty they have about the 18 months that follow.
Let's touch on a couple other investor concerns. The idea that ALD, atomic layer deposition, is going to eat into AMAT's dominance in PVD.
Management pushed back on that hard. They basically said you need PVD for low resistance wiring. If the tiny wires in a chip have high resistance, it wastes power and creates heat. AI servers can't have that.
So their strategy isn't PVD versus ALD.
No, it's PVD and ALD together. Their winning formula is an integrated platform that combines both to get like a 50% improvement in resistivity. It's about integration creating that moat.
Okay, last thing. Their foundry logic segment grew only 3%. That seems to lag some peers.
It's a crucial nuance. Management explained that being restricted from selling their high-share DRAM tools to China really skewed that overall number.
So the 3% figure is misleading.
Very. They're confident that where they actually can compete, in leading-edge stuff like gate-all-around, they are gaining share.
All right. We've broken down the near-term pain versus the long-term AI gain. Let's talk about how traders might play this. This is not financial advice.
Okay. So we know the stock is being punished for two things. 6 months of flatness and the $600 million China question mark.
But we also know management is incredibly confident about that acceleration coming in late 2026.
So what's the outrageous but plausible pitch?
The pitch is a long call spread, betting that AMAT reaches $270 by early 2027.
Wow, okay. That's a pretty high target and a long time horizon. You're wagering that the first half softness is just a big red herring.
Exactly. It's an opportunity. We're betting that a simpler, longer-term trade is better here because the risk is more structural than cyclical. We're banking on one of two things happening.
Let me guess. Either the China situation gets better.
Right. Either the $600 million headwind gets wiped out by a permanent extension of that affiliates rule, giving them a surprise revenue boost.
Yeah.
Or the AI ramp in the second half of 26 and into 27 is just so explosive that the China problem becomes, well, a rounding error.
I see. So you're using today's pessimism as the entry point for a very confident bet on their AI product roadmap and that unique visibility they claim to have.
To recap our deep dive on applied materials, a record fiscal year 25, powered by strong margins and their very stable services business.
And their entire future strategy is locked into the AI supercycle with these foundational tools like Centura and Kinex that give them a really powerful moat.
But all that long-term strength is being discounted right now because of the flat demand coming in the first half of 26 and the regulatory friction from China.
So what's the final thought for you? Management made a really bold claim. They said they're positioned to capture more than 50% of the market in key areas like gate-all-around.
The ultimate metric to watch then is whether those new high-value AI products actually convert that positioning into real high-volume market share gains when the industry ramps in the second half of 2026.
If they do that, all this regulatory noise just becomes background chatter. That is the proof point.
Thank you for joining us for this deep dive. And remember, this conversation is for informational purposes only and is not investment advice.